0 to 100 employees, 0 to 60 million of revenue experience with that business. It was probably endangering our lives. I had a guy threaten to kill me. Prices just kept going down. And that means that margins kept getting compressed. Leaving law when I was sort of a year away from partnership, the best investment I made was super awesome. It was building a new internet for kids. Well, one LP, yeah, so we are a different structure. So we're not in a position where we have to deploy. You can actually be really, really disciplined. Managing partner of a firm, I think you generally would spend a majority of your time fundraising. So I can spend all of that with the team and with our founders. And one thing we look at is Series A graduation rate for our portfolio. We're running at 78% from pre-seed. The industry average is more like 20%.
Today's guest is Chris Smith, managing partner at Playfair Capital. Chris started a telecoms business whilst still at university. He then graduated and spent a long time as a corporate lawyer, making some incredible angel investments. He then left to join a really unique family office up in the Isle of Man. He now runs pre-seed investing at Playfair Capital. It's a fantastic episode. Let's get stuck in. But just before we do, let me introduce this week's sponsor of the OpenVC Podcast, intercom.com. Intercom help founders by making your customer service 24/7. Through their use of innovative AI, you can answer 50% of your customer needs instantly. Intercom is offering 1 year free if you use the code OpenVC, all in caps, at the checkout, using the link in the description below. And let's get back to the episode. Chris, wow, thank you so much for coming on the first season of the OpenVC podcast.
This is my first podcast in about a year because I've been on paternity leave, so looking forward to it.
Wow, well, that's an absolute treat for us. So let me test your memory and take you all the way back to your first ever business, Just Dial Student, telecoms business that you started whilst at university. How did you build a business as a student?
That's right. So I was 19, so it's a long time ago, as my wife reminds me. It was a combination of a couple of things, actually. I took a year out between school and university and went to the US, and I spent about 6 months there, boringly enough, working in a law firm. It'll become clear why later on, I think. And I got a really massive phone bill, speaking to my girlfriend at the time. It was about £700. My dad was furious, and I was thinking, how am I ever going to repay this? So that was one thing I kind of held in my mind. And then I went to university in London, and I was immediately shocked, having grown up in a little village about 40 miles outside London. There was like 80 different nationalities in my law faculty, all of whom needed to call back home. And then the third thing was an advert on the tube for a new way of making calls that was essentially free to the user, but obviously the company was somehow making money. So all three of those things kind of came together. I reached out to the company offering this new service and became one of their first agents. So that's how it started.
Amazing. Okay, so you're highly switched on. It wasn't just an idea. You actually did manage to grow this quite significantly and scale it into 14 different countries. What were some of your favorite memories going back to the time of growing that business?
So I think probably a couple of things. So first of all, meeting a co-founder, because what that story doesn't tell you so far is that the first month I made about £4. And the second month it was about £8 and then £9. And I wasn't really getting anywhere because I have a limited skill set. I met a co-founder who was a brilliant graphic designer who could put together a website and flyers and everything else. And so together, we then started to make really good progress and started to grow the business nicely. So meeting that co-founder was absolutely pivotal and adding the skills that I didn't have. But I think my favorite memory actually was in 2004. We launched in Spain, which was our second country. And to do that kind of market entry, we got 50,000 flyers printed up in the UK, sent to Spain in a van. We basically took Spain 6 weeks on the Costa del Sol. We went everywhere from Gibraltar to Nerja. We drove down every single off-ramp of the main road and flyered the shit out of every community we could find. So the strategy was basically go to estate agents, expat bars, any British registered cars, we would hit them with flyers. And then we had posters, which we would put across the, in the south of Spain, you've got the bullfighting posters. We put it over the bullfighting posters. We realised, actually, it was probably endangering our lives because there's a little bit of a, thing going with bullfighting. Anyway, we blitzed the whole coast and ended up going from sort of nothing to a couple of €1,000 in revenue a month very, very quickly. And on top of that, I was chased by a dog. I had a guy threaten to kill me because he thought we used to put the flyers down in the door seal of the driver's side of the car, because that way people always see them, you're not gonna miss it. But it also looks like you're trying to steal the car. This guy comes tearing across the car park outside Carrefour, going, oi, 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 oi. And I was like, it's okay, I'm just cheap international calls, mate. It's fine.
Amazing. Was that all was that a self-service product, or were you having to onboard customers each
Yeah,
time they would come on?
it was instant dial. So basically, the way it worked was we had a number which I still remember. It was 902 902 952. And basically, what happens? You'd call that number, and then you could enter your international number, which could be you could call about 40 different countries, including importantly the UK. Your telephone company in Spain would bill you for it, or it would be included in your free minutes you had in your mobile package, and we made money on it. It's a bit complicated how it worked, but basically we would make some money on it. Yeah, so it was great. We realised the expat community there is super tight. So if you go into one town and you tell the estate agent, the expat bar, the gym, everyone starts talking about it. I think it's a good reminder to founders as well that sometimes brute force, flyers, like real world marketing can actually be really effective. Like not everything has to be online.
I was going to prompt you on that, flyers. Did you know that that was going to work before you printed 50,000? Had you tested that strategy in London before?
Yeah, we had done a lot of flyering at different tube stations. So the strategy there was we knew broadly you can get data that tells you what nationalities live in near which tube station. So we would go and do like South Africa flyers in Wimbledon, I think it was, I can't remember. But yeah, basically we would do that, and that worked very effectively.
And so you're having an absolute amazing time, some life-threatening moments within in Spain there. Were there any tough moments, any challenging times where you thought maybe this is the end of the road?
So I think the biggest problem in telecoms generally, and it's a market thing, is that prices just kept going down, and that means that margins kept getting compressed. So when I started, a call to India, for example, was like 10p a minute, and we could make 4, 5p, 6p on that. Just really decent margins. By the time we were kind of getting towards the end of university and starting to think about next career steps, it was like 1 penny or half a penny. It just wasn't enough margin left, and so it really meant that we were just chasing volume to maintain the same level of income. And it just kind of felt like one of those businesses that was a little bit built on sand, actually. Like I never planned this to be a venture scale business or whatever. It got harder and harder and harder. You had to get more and more volume. And actually, the other stupid thing we did strategically, I thought I was really smart going after students. And then actually it turns out, well, students are only in the country for, I don't know, 6, 7, 8 months a year. And then they graduate, and a lot of these students sort of either went back home or to a third country. And so our market kept going away. So I learned lots from it. But yeah, the hardest thing was just pricing pressure.
So tough lessons to learn as a young entrepreneur, but great life lessons. You've had a really long career as a corporate lawyer. How do you balance your entrepreneurial mindset with the strict structure that comes with being a lawyer, having to deal with templates and, operating within the realms of the law?
Yeah, and you say a long time, too long. I
Okay.
wanted to get out of law almost as soon as I started, and then we had the financial crisis in 2008. It was really tough to get out. I think law teaches you some good stuff. It teaches you mentioned resilience earlier. It teaches you incredible resilience, stamina. You work really long hours, and actually the service mentality you have as a lawyer is really helpful in venture because we're ultimately a service business, right, towards our founders. So there's a bunch of good stuff. It was hard to juggle. I felt very constrained by the work I was doing, and I realized that actually I was basically the last person people talk to about anything interesting happening in the like business and M&A world. The company first would decide to do something cool. They then
Yeah.
call the bankers who would help them do that something, and then they come to me last to go, please paper it. So quite frustrating. My outlet actually was angel investing. So I would go on at the time, Angel's Den, and then Angel List was actually open. So you could go on Angel List and you could look at individual companies as opposed to syndicates. So my spare time, which often was like 2 a.m. getting a taxi back home, was spent browsing companies, like thinking about what they were doing, figuring out if I should make an investment or not. So that's kind of how I balanced it.
So a lot of the lawyers that I speak to at the moment, they tend to be very risk averse.
Yeah.
And I thought that was maybe summarized as the cohort. So you're very much standing out from the rest with a high risk appetite and willing to make angel investments. And you mentioned their angel list. Were you making those investments whilst in the UK? Because I know that you had time in San Francisco as well as a corporate lawyer, and that sort of exploded your access and opportunity to invest into some really incredible early stage companies.
Yeah, I think honestly, I hadn't thought about angel investing before going to Silicon Valley. Every day for lunch, I would go across the street, this bagel shop, and in there were people, I later learned were doing pitches, basically. They were talking about their company, pitching to angels, VCs, I don't know the detail. But it got me thinking almost from a kind of like an academic perspective, like what is going on here? And I started to research like Georges Doriot, like the founding father of venture. So what I figured out as a lawyer was partners earn a ton of money but they only do it while they're slaving away, like working 18, 20 hours a day. It just felt like a pretty miserable existence. Actually, if you build a software company, you can sell that software repeatedly while you sleep. And then also, if you own part of that company, you're building, equity value, capital value. So I just thought this makes a lot more sense of how I would want to run a business or how I want to spend my time. And it was actually only after I got back from Silicon Valley, I made my first angel investment in a food business, bizarrely. But it was the seed had been sown, definitely during that time in the US.
Amazing. So were you part of like angel syndicates, or you were literally just absorbing this from the outside informally?
Yeah, from the outside. I was never part of a syndicate. I didn't really know any other angels, kind of like this weird lawyer lone wolf, I guess, writing checks. But the market was very different back in the day. Like access was far easier. Like I said, AngelList was open. So I could literally look at every great company and there were nowhere near as many angels competing on deals and writing checks. So it was somewhat easier, but the barrier to entry was a little bit higher because typical minimum check was like 25K back then.
Well, you didn't just learn from the best, but you managed to put that into practice and created a fantastic initial portfolio. So I think of 15 early investments that you made, 6 actually ended up having significant exits,
Yeah.
which is a phenomenal ratio for any first-time angel. What was the secret? What were you doing so well that made you an incredible investor?
God, this is where I wish I was a bit more American. I could say how brilliant I am. There's a lot of luck, honestly. I think we know the data, right? You should actually have a much bigger portfolio than I did. I love overlooked areas. I love areas that other people are not looking. And I think if you look at some of those investments, Compology, an SF-based company, was doing garbage management. It was a system that allowed haulage trucks to monitor what was in the bins and the dumpsters to have more efficient routing and therefore reduce costs and CO2. Most people aren't interested in garbage. And then, probably the best investment I made was super awesome. Dylan Collins, his third company, it was building a new internet for kids. And I was like, what are you talking about? This doesn't make any sense. So I like that. Adjacent to hot markets, overlooked areas, I think was a big part of it. And luck. This business venture, you kind of there's a lot of luck.
It's a very humble answer, but this is the podcast. I'm going to have to prompt you to dive into this a little bit. Unpick this luck. What kind of things were you doing to make yourself luckier? Were you putting yourself in the right places? Were you meeting with hundreds of founders? Were you doing rigorous due diligence? What sort of processes did you have in place to help you identify these outliers?
Yeah, so today at Playfair it's quite different. We have a very rigorous process that I could definitely point to has helped us probably outperform. Back then, I think it was more taking a lot of what I'd done in hiring and recruits. I did a lot of hiring in the law firm I was at, and particularly finding sort of future trainee cohorts. I think it was a lot of that and looking for maybe those character traits, those things that help people stand out. And as an angel back then, I didn't have much time. I was working these sort of crazy hours as a lawyer. So I really only took usually a half an hour call with the founders and the decision was made on that basis. It was, can they inspire me? Can they light me up? Can they make me feel like I want to go and work for them? And I think I've seen that people, I think maybe it was Fred at Stride, described it as sparkle perhaps. I think it's attributed to him, but this X factor, this sparkle, if they can do that to me, they can do it to other investors, they can do it to people they want to hire, and hopefully they can do it to customers. And I still use that to this day at Playfair, but then just back it up with a ton of work and diligence and references and everything else.
Amazing. Was there conscious thinking behind staying away from the sexier, the hotter spaces? Had you seen bubbles crash and explode and then you're consciously trying to get into more resilient spaces?
Yeah, I still remember 99. I mean, I was still at school, so I'm not that old. I still remember Boo.com, this crazy online fashion retailer that raised hundreds of millions and crashed and burned and it never really worked. And there's Webvan and I still remember that bubble. And you can see these, you can see them coming. We're in one now. Everyone says it's different this time. It's not. It's another bubble. So I definitely steered away from that. And I think there is something I'm naturally a little bit of a contrarian. It's one of those things I don't know how to explain. I don't know why. But, I'm the only person in my firm. Actually, no, since Matt, the CFO, joined, with 2 of us. But I'm the only person who has a PC, and I'm the only person who uses Android. So I think I'm probably barred from a lot of VC clubs for that reason alone. But I've always just felt like I want to go against the herd because I think that's where you find alpha. And I think we try to describe it in a few words. And I think sort of non-consensus is something we've landed on our recent Playfair offsite, investment team offsite, because it's kind of what we're looking for. If everyone's looking at the same thing, it's very hard to generate outsized returns. You need to be looking at places where other people are not.
And suddenly pricing discipline becomes impossible because if you have any, you're going to lose the deals.
Exactly. And yeah, as an angel, you don't want to be massively overpaying because you're not going to generate return. And same as a relatively small fund today, it doesn't make sense for us to be chasing valuations.
How does that story resonate with LPs? you're going out, you're pitching the fund. Although actually, I think Playfair's quite unique in that you have one
Yeah.
LP.
Our
Okay.
LP, our one LP, yeah. Yeah, so we are a different structure. So we were set up by a guy, Fede, pretty well known in the London ecosystem back in the day. Started as an angel, set up the fund, and continues to be our sole LP to this day. Having said, he likes that approach. I think he does not want to be chasing hype. He wants to be chasing alpha in these overlooked spaces, these unusual spaces, and everything else. So I think it resonates pretty well with him, as does the discipline. And I think with one LP, we're not in a position where we have to deploy and go back to him and say, look, we've managed to get into these sexy sectors. We've managed to do 20 deals this year. We can actually be really disciplined, stick to our 6 a year, and actually do less if we feel the market's overvalued or if we can't find what we're looking for.
It's an amazing strength, actually, only having one LP. It probably enables you to make very quick decisions and be a bit more unconventional compared to someone that has many different LPs that they have to answer to and stay accountable for.
Biggest thing is time. I think, as a managing partner of a firm, I think you generally would spend a lot, if not the majority of your time fundraising and managing those LP relationships. I spend, well, Fede and I chat regularly, but it's not a huge amount of time.
Yeah.
So I can spend all of that with the team and with our founders. And I think that makes a huge difference.
Okay, so let's just step back for a second. You're making all these really incredible angel investments. You're having something, well, the exits wouldn't have happened yet. How did you end up formalizing the transition from corporate lawyer that sometimes makes angel investments on the side to Playfair managing partner in 2018?
Well, first of all, I thought I never would. I thought in my head it was a place for ex-bankers and highly numeric quantitative people who run spreadsheets. So that was my starting point. What I ended up doing, I left law in 2012, 2013, and I moved to the Isle of Man to join a family office. And that was probably, I think that's probably the biggest risk I've taken, because leaving law when I was sort of a year away from partnership, to a sort of unknown entity on the Isle of Man. But what it offered me was the ability to get in an operational role in a couple of companies. So I worked with Van Capital, which was a litigation funding business, just briefly about 6 months. But most of the time I worked with Plan.com, which is a telecoms business. So kind of almost back to my roots a little bit. And there I worked both on the tech side, running a tech team for a couple of years, and also worked as sales director and ran the sales team, and had this like whole sort of 0 to 100 employees, 0 to 60 million of revenue experience with that business. So that was the transition. And it was incredibly lucky again, because the original role advertised was to be an investment manager of a family office. Turns out the guy who runs the family office, Dan, he's a brilliant guy, but he is a hands-on operator. And he didn't want to get to like 10, 15 companies in the portfolio. He wanted 2, and he wanted to be the CEO and really focus on them. So it worked brilliantly for me. And I was rubbish for the first 3 months in that role, particularly in sales. I had no idea what I was doing. I couldn't motivate people. I would send them emails going, please do sales. And they wouldn't do them. And I worked out. One thing a lot of people don't talk about actually is if you're in the corporate world, what you realize is that you're a different version of yourself when you're at work. And it took me a good 6 to 12 months to shake that off and become me. And now I'm me at work and me at home and me everywhere. And God, it's so much better.
Wow. You're 1 year away from making partner at your law firm, something
Yeah.
that people have set their entire careers on. There's so much social pressure. When are you going to get that promotion? Who am I going to beat to get that promotion? And you manage to have the self-awareness to step away, think, look, this actually isn't the trajectory that I want to continue. I'm going to go to the Isle of Man to join a fairly unknown family office. That's amazing. That's a huge risk that you've taken that paid off tremendously for you. And then this family office, was it investing at the seed stage? Like, at what stage did you manage to join?
Making me nervous looking back. That's crazy. So it wasn't seed stage. It was more, I'd say, in the way we think of things, it's more like venture building, like company building. So,
Okay.
Dan, who ran it, would find some really interesting entrepreneurs, and he would put the resources around it. They'd do a deal. They'd agree what the company looked like, and they'd go forward. So actually, most of these businesses were majority owned by the family office. And they were, interestingly, his strategy was pretty smart. He was in industries that needed a lot of capital. So litigation funding, you need a lot of money to front up to fund the cases, and then telecoms. In this particular business model, you needed a lot of money to pay commission to the resellers you're working with. So really smart. He made a lot of money in a previous business. He was able to redeploy it and build these companies.
Okay. And then you cut your teeth as an operator in the tech team, in the sales team. How do you leverage that experience to then become an investor again? Did you enjoy being an operator, or did you actually end up realizing that you'd rather be an investor making several bets a year?
So I loved being an operator, but I loved the first 2-ish years. So when you're all sitting around one table, when you're building, where decisions are just so quick and you're wearing loads and loads of hats. What I enjoyed less was like the latter stages of that business where we had 100 people. Everything just got a little bit by committee. It was a bit slower. Everyone has to become more specialized. And so suddenly you're a little bit in a silo again. It reminded me a bit of being a lawyer. Like, you're overly specialized, which is far less exciting. So I think I realized I enjoyed that first couple of years. And I think when I wanted to leave the Isle of Man, it was professional, but also personal, because my girlfriend, now wife, was coming back to the UK. And actually, it was Charlie at PER, who I've spoken to for years, and like a few others in my network. And they just said, well, obviously you're an investor. What are you talking about? You've made 15 investments. At the time, I had a couple of exits. You are an investor. And it gave me that kind of confidence boost to go, okay, cool, I am. And then it was a matter of luck finding the Playfair role.
Wow. Can you remember what it was like interviewing for the Playfair role? Were you put under any specific tests? Were there any like very tricky aspects to that?
My memory is it was really fun, and
Okay.
I knew from the first call. So my first call, I was in a car park in the Isle of Man, crouched down behind a car, hiding, because the Isle of Man's a very small place, and it was extremely windy. So I was trying to get out of the wind. So I'm kind of like sideways, like crouched down behind the car, talking to Joe Thornton, my former partner, about what I was doing. And what was crazy is everything I told him about the telecoms business, being a lawyer and hating it broadly, and then he was like, oh yeah, this is great. This is exactly what we're looking for. I was like, how is this fit? But it was just a really exciting realization that the way Playfair thought about things was they want people who aren't, necessarily all ex-bankers. They want people who have done angel investing, who have empathy for founders, who think about the world differently. So it was a really good fit from the start. It was about a 3-4 month process before they made the offer, and we knew it felt right.
Okay, so not a big risk, but you sort of knew that you liked investing. As you said, you'd already had some traction from your angel portfolio. Did you continue making angel investments whilst in the Isle of Man? Was that something that you continued to do, or not so much?
Yeah, it was. Well, first of all, the income went down a bit on the Isle of Man compared to being a lawyer. So it definitely slowed down a little bit, and the checks got smaller. Funnily enough, though, actually, the company I mentioned earlier, Super Awesome, which I think it definitely is my best angel investment in terms of outcome, that happened largely because of being on the Isle of Man. So I originally met the founder when I was a lawyer at Olswang, and in a really weird meeting, actually. So the partner I was sharing a room with, because you share rooms, it's pretty old school. He took me to meet Dylan Collins, who was the founder of Super Awesome. And in that meeting, because I was junior, I said nothing. I just sat there. And the partner was chatting away, trying to sell himself, and it was a bit cringy. But I just remember thinking, geez, this Dylan guy, he's onto something with Super Awesome, building this internet for kids. So I followed up with him post leaving the law firm and said, hey, I'd really enjoyed meeting you. Are you raising? Yeah, I've got this amount left in the round. Cool, I'll write a check. And then the reason I doubled down in that company and wrote my biggest ever check is because of something that happened on the Isle of Man. So I went to my boss, Dan, who is a brilliant entrepreneur, right? But he's already made it. And he's, as he said to me, he's in the business of preserving capital. He doesn't really need to make any. So I told him about Super Awesome. I said, look, this is an amazing company. What do you think? And he's like, I'm not interested in writing tiny checks into tiny companies. Something like that. And I was like, damn it. That's really pissed me off. So I went to Dylan and said, right, I'm in. I'm going to double down. I'm going to write an even bigger check. So actually my being annoyed at my boss at the time meant I put twice as much as I usually would into that company and had an even better outcome.
Fantastic. Wow. And just to tell our audience how successful that investment was, can you tell us any metrics on the returns there?
It was about 11x on that.
Wow. Amazing. And was that SEIS, EIS, capital gains free?
It wasn't because I was in the Isle of Man. Yeah, I know. Yeah, funny enough,
Brutal.
I lost the EIS. I couldn't do EIS, and then by the time I exited, I was back in the UK.
Oh, we need to change those rules, don't we? That's unfair.
I don't know. It was okay being on the Isle of Man for 5 years. You don't pay an awful lot of tax there.
Okay. Amazing. All right. I feel like we're jumping all over the place, but that's, yeah, fantastic stories. Thank you for this. You've joined Playfair. It's been a 3 month onboarding process. You like the team, you like what they're doing. Can you tell us today a bit more about Playfair's investment thesis?
Yeah, of course. And it's been a journey, right? We've refined this over the last sort of 11, 12 years. So we started out as a do anything fund in Fund 1, and that was largely when we were led by Fede, and actually beautiful investing. He was investing with that angel mindset, and so was the team. Just great company, don't care about stage, we'll go. And then Fund 2, which we fully deployed a few years ago now, was pre-seed and seed, and then Fund 3 is exclusively pre-seed. And I think we've worked out over the years, that's our sweet spot. And I think we've figure that out because of results. So, one thing we look at is Series A graduation rate for our portfolio. we're running at 78% from pre-seed. The industry average is more like 20%. So something is working. And I think that something is the combination of what you're alluding to. So we kind of think it's non-consensus, not always. We sometimes invest in companies that loads of other investors like as well, that's fine. But just trying to find these companies that are on the edge of hot markets, they're adjacent to hot markets, or that are completely overlooked, a few of those later. And then the concentrated strategy, 6 investments a year, I think we have the mentality of pre-seed or even angel investors. Like we get very excited when we meet founders that kind of light us up, like I was talking about before. That's the first call. But then we do an awful lot of work to validate those feelings. And I think we almost underwrite investments like Series A funds do. So we write meaningful investment memos. We do a bunch of referencing and everything else. I think a lot of founders are a bit nervous about that, but we do it quickly, very quickly, actually. We've done it in 6 days, usually it's a couple of weeks. But actually, it should be a really good process with the founders, because generally we discover a few things that might be helpful to them, whether it's sort of customer intros or observations on the market. So I think that's a really fun process. So we go deep, we only do 6 investments a year. And then post-investment, we spend a lot of time with those companies. And I think everyone's like, well, what's your value add? Well, look, we've got a CFO on board who helps with the finance piece. I've got the sales and go-to-market background, so is my colleague Chef. We've got, expertise around marketing. We've got a bunch of different things. But to me, ultimately, it's just about being available to founders and having time for founders to really understand the business and being with them on the journey. And then maybe one final point to touch on. We're generalists, so we look at everything at kind of pre-seed. I'd say I think we like B2B. We like deeper tech. We like deep tech and deeper tech. To be clear, there's almost 2 categories there. So we like things that are hard to build, that are complicated. So there's a bit of defensibility there. And yeah, I'll pause there. But that's kind of the overview, I guess, of how we approach things.
Fantastic. Okay, incredible. What are you doing to de-risk the investment on day one that allows you to have a 4 times higher graduation rate with your portfolio going to Series A than industry average? That's a really significant step change.
I think it's just a combination of a lot of different things. So one thing, we only invest actually where one of us, so the company lead, is really passionate about what the founders are building. So we have seen companies before that we think, they could build a really interesting, insurtech business in the space. They could probably make a lot of money. I'm just not interested. I think that creates a really strong alignment between the sort of the company lead and the founders from day one. So that's maybe a helpful starting point. I think actually having a natural filter, we only do 6 investments a year, so the bar is naturally very high. We are disciplined. We never say it's good enough. It has to be excellent, right? Last year, we did 5 investments in the first half of the year. We did none in the second half. And a lot of funds would be a bit nervous. Their LPs were great because nothing hit the bar. So I think being disciplined and holding that bar pretty high is key. I think the point we were talking about earlier, actually, about not having external LPs to spend a huge amount of time with. We spend a lot more time with founders, and as a team as well. So if a founder is stuck on sales, they can talk to me and Chef. We'll go through everything from setting up your CRM, thinking about lead qualification, thinking about lead generation, thinking about A/B testing your outreach messages on LinkedIn or whatever it is. Like we generally are zoomed out and we let founders get on with it as they want to, but we'll zoom in whenever they need us to. And I think that helps enormously. And then maybe the final ingredient actually is just helping with fundraising. I feel like a lot of funds talk a good game and we'll help you with your next round. We don't really see it in the market. But, when we have a company going out to raise, we're running the Notion page for them if they want us to. We are encouraging them to have a couple of 100 leads in the top of that funnel. We're encouraging them to go out and start coffee and relationship building chats early. So I think that makes a pretty significant difference as well.
Okay, thank you. So much there to unpick. I suppose just from a higher level, when you're doing a lot of due diligence on startups, even ones that you like, they're going to have some skeletons in the closet. There's going to be things you uncover that you aren't very happy with. Whether that's the founder's fault, whether that's the market dynamics. How do you know what to listen to and what to ignore for the things that might not be, for the indicators that aren't all positive?
Yeah. Well, I think at pre-seed there generally aren't that many skeletons because they haven't been around long enough to live and die.
Yeah.
there isn't actually usually that much to go. And I think that's what confuses people actually about how can we do so much work when the company is like a deck and a couple of founders. I think the really important thing is we build conviction in the founders and the founding team. We think they're the right people to go and build in this space. They're the best people in the world to go and do this. And I think that's one piece of it. And then everything else is mainly about market validation. It's about, is the problem statement correct? Is it a little bit overstated? Is it understated? How do we think about that? And then what do we think about buyers? What's their attitude? How do they think about this particular product or service? Do we think they're likely to buy it? And that is talking to 20, 30, 40 potential buyers.
Wow, that many.
Yeah, we discover an awful lot doing that. And the nice thing about it is it doesn't take any of the founders' time. So to go back to my point earlier, I think founders are a bit, oh God, you do a lot of diligence. We speak to founders, like first pitch, second pitch. They'll probably have a whole like session with the team, maybe a few more chats, and then we take it to IC. And actually, they don't even attend IC. We do IC because we've got everything we need. They don't have to come and pitch to us. So actually, the amount of time they spend with us isn't probably not that much greater than other funds, but we just do a lot of this work in the background. And I think that really helps validate our decision making.
So let's dive into some of the portfolio at
Yeah,
Playfair.
yeah.
What has been the largest exit so far?
It's actually one that is just about closed, but not public. So WorldPay have agreed to acquire Ravlin. And Ravlin was a Fund One company we invested about 10 years ago in the fraud detection and prevention space. So I can't talk any metrics, but it's public. It's being acquired by WorldPay. Fantastic home for them and really good outcome for the fund. So very excited about that one.
Amazing. Okay, so thank you. How about the largest paper gain so far?
It's probably going to be between, I'm going to talk about an old one. So Thought Machine, again, one of our Fund One companies, builds core banking software, founded by a serial entrepreneur, Paul Taylor. They're doing amazing things, re-platforming like the world's biggest banks and taking them from technology that's 30 years old to completely up to date and cloud native. And then the other one is probably right now Protects AI. So they just announced their Series B, which was led by Head of Sophia, and Salesforce came in as well. And they do basic health and safety technology. So they are in the business of preventing accidents and deaths in workplaces, so particularly things like warehouses and commercial facilities. Very, very cool business. So they effectively, what would happen before with health and safety? You'd have a person in a reflective jacket going around with a clipboard, occasionally checking that the forklift truck was not driving across somewhere people walk. This turns that into 24 monitoring with the rules that you set and prevents accidents. And
Wow.
I think you and me, right, we're sitting at a desk right now. It's unlikely anything's going to fall on our head or we're going to get crushed, but there are a lot of people who are exposed to that risk every day. So they've got customers like Amazon and Tesla and DHL, and they've expanded in the US. So really excited about that one.
Fantastic. And I love how all of those three companies that you mentioned might have been categorized as unsexy industries. So very true to the ethos of
Yeah.
investing in unconventional spaces. Okay. How does Playfair think about follow-on capital? So you like to invest extremely early with pre-seed, and the range of check on your website says between 100K and 1.5 million. Is that
Yes.
the first capital deployment, or is that throughout the life cycle of a portfolio company?
That's the first check, and the total will
Okay.
be quite a lot more than that. So I think recently I've started to notice that a lot of funds at pre-seed have a sort of one check strategy. So they will come in, write a check, maybe taking advantage of SCIS or not, but they'll write one check, and then the company's kind of on its own. I think that model worked really well in 2021 when things were like booming a little bit more. There was enough capital to go around. I think today, as a founder, you're quite exposed if you take that capital. So our view has been we need enough firepower to get companies to Series A. So we will do the pre-seed. As you say, it could be 100K if it's going into a friends and family or angel round. Average check's more like 750. And then we will often lead an internal seed plus or seed round, whatever you want to call it, and then participate meaningfully at the Series A. So in the past, we did that with two companies, so AeroCloud and Continuum Industries. We led the internal Seed Plus round. They've gone on to raise really good Series A rounds. AeroCloud from stage 2, great fund in the US, and then Continuum from Singular, great fund in Europe. That strategy worked really well. So one of the reasons that Fund 3 was twice the size of Fund 2, we're actually going to make the same number of investments, around 25 for the fund, but we're going to have enough capital to do more of those Seed Plus rounds and have enough to follow at Series A. So that is how we think about follow-on. I reckon about 40% goes into initial check and about 60% into follow-on.
Fantastic. Wow. So that's great for your founders as well, because not only do
Yeah,
they gain time with you, but there can be that positive signaling of continued support by Playfair when they go to market again. Whereas other founders that raise money from the one ticket funds, they lose that support and they're back to square one and raising momentum for their next round, which can be really, really tough.
I think that's right. I think with the one check, as long as most people in the market know who the one check funds are, so it's not quite as bad, but I still think it's a real challenge. And what it also means actually is a huge time burden on the founders. It's a massive difference coming to us and saying, okay, these are the metrics we said we were going to hit with the money you gave us. This is what we've done. Are you open to providing more capital? And so I think in the case of, I mentioned AeroCloud, Continuum. Actually, Yasso, we did the same recently, doing this kind of seed extension round. This is not a process that takes very long. This is, come and chat to us, maybe an hour, a couple of hours, up-to-date financial model done. Whereas if you're going externally to your seed round, you're doing a full 3 to 6 month process. I think there's a huge advantage there.
Fantastic. Okay, so we talked about the positives of having a really, really tight investment thesis, being contrarian,
Yeah.
but there must have been moments where that has been a bit costly in terms of your anti-portfolio. So do you have any memorable stories about things that the team might have missed for good reasons at the time that have gone on to be wildly successful?
Yeah, yeah. I think this is both that and maybe also a story about discipline. So it's kind of both. Hopping. So I
Ah,
think everyone knows about hopping, right? The
mhm.
rise and then subsequent fall. They submitted a deck via our website. So it was it was basically cold inbound with what ended up being one of the hottest companies probably in the world for like at least a couple of years. And we didn't do it. And we felt like idiots for quite a long time. So when the valuation went, it was like a billion. You got like to 5 or 6 billion. And we're like, wow. I mean that it's fast. That would be a huge paper gain. Clearly, we missed something. We must be really stupid. And then we started to see that business, let's just call it face headwinds, right? I think it was really propelled by the pandemic. And then the world sort of started to unfreeze and people started to want to meet in person again. And suddenly the business model just looked a bit more challenging and it started to come apart a little bit. And then we're like, oh, actually, no, okay, fine. This was okay. Like we kind of, our read was correct. And to me, that in a nutshell is venture. Like one day you can feel really smart and you think, yeah, I've made the right bet and it's all going up. The next day you can feel like a complete idiot because you missed something and you got the read wrong. No one knows until you ultimately sell that business. We only care about generating returns and for the founders to make a load of money at the end and for our LP and the fund to make money. So it's yeah, Hopping made us feel really stupid for a couple of years.
Yeah, the challenge is the feedback cycle, right? Because
Yeah,
people are trying to get promoted. They've won a couple of years at each role and they need that write up to help justify their promotion. So it's a little bit backwards in terms of the internal incentives at VC funds in comparison to real world value creation from these portfolio companies.
exactly. And I think also there's also a sort of it's kind of like a morale piece with the team. So doing deals is fun. I mean, actually, working with companies post deals more fun, but doing deals is fun. There's adrenaline. It's exciting. When you only do six a year, we don't get as many of those moments as you would if you were doing more. I think it can become a little bit frustrating sometimes to see your mates at other funds like constantly bashing out checks and like they're full of adrenaline. That kind of looks quite fun. But ultimately we've got to have that maintain that discipline because we want to generate the returns. 10, 12, 15 years down the line.
Okay. No, fantastic. Okay. So you've got your thesis, extremely disciplined with pre-seed stage, ticket size, sector agnostic focus. What are some of the challenges that comes with your model compared to other VC funds? What do you think are some of the larger challenges that you've had to overcome?
Yeah, look, I think we can't afford to make some investments. I think that's
Mm,
probably the biggest challenge. So we will see investments that we think are actually quite interesting, are quite attractive when they are in a hot space right now. It's AI. It just doesn't make sense for us. So we need 10% ownership. Right? That's what we target, and that has to be priced a certain way for that to make sense. And so when you see pre-seed rounds of 4, 5, 6 million, or even like 80 million, right, with some of these crazy deals, it just doesn't make any sense to us. And I think I actually that doesn't bother me particularly because I want to find the overlooked stuff. But I think as a team, you can go weeks and months seeing these big deals happening and thinking, how are we ever going to find anything that's, good enough and exciting enough for us? It always happens, but that can be a little bit frustrating.
okay, thank you. And in terms of just to unpick that deal sourcing strategy, what kind of things do you do to identify the next outlier company that is perfect for Playfair?
Yeah, look, this is an ongoing debate. I don't think there's a sort of really settled way of doing this because you've got a mixture of inbound and outbound. So we do a lot of outbound. We've built a proprietary tech stack, which is it's pretty smart. We do a bunch of things with LinkedIn and a bunch of things with Companies House, and like we do a lot of stuff to find things early. So that's really helpful at getting breadth. We obviously have inbound through the website and through directly, which is I guess why it's important to build the brand and for founders to understand who we are. So we get that, and then we get a lot of fund referrals and relationships and events. There's like all these tons of different ways of kind of sourcing opportunities. The thing is, the best company can come from anywhere. So you can't really just say we're just going to do outbound or we're just going to do referrals or whatever. I think actually Protex AI, the company I mentioned that went up to raise that amazing Series B, cold inbound. So, the myth that you have to have relationships with existing VCs or network or whatever just doesn't stack. Continuum Industries actually was cold inbound. I mentioned that earlier. So we need to look broad, and we need to have a really effective process at triaging those companies through to come to the team for review. And that's what we've kind of worked on, actually. So we have a very effective system to quickly review every company, it gets seen by a couple of members of the team, and then it comes for debate and discussion with the rest of the team and the partners.
Wow. Is there any AI filtering before the team even see it? Or the team sees
None.
literally everything, there is a human input at every stage?
Yeah, none. This has been a very interesting internal debate as well. So I think if we can use AI to synthesize information to make it easier to review, maybe we would consider it. But there's also a part of it that goes, actually, I kind of think we owe it to founders to read their content. And one thing we added recently to our pitch form, we added a video upload button. So you can upload a 60-second video pitch, because actually deck tells you a good amount of the story. But because we're investing in founders, like founders are 80, 90, 95% of the equation here, we kind of want to see you, and we want to see your energy and your excitement for what you're building. So there's a video thing now as well. Yeah, I don't think we're going to use AI heavily in the deal screening phase, because I think, again, we want to read and see what the founders are doing. Whether we can use it effectively to give feedback, maybe, I don't know. We'll have a look.
Amazing. And it's so tough for founders when they're applying to all these funds. It's nice to know that if you apply to Playfair, humans are actually going to read your deck.
Everything gets read, yeah, often by more than one person, I think. And actually on feedback, kind of what we discussed internally and what we agreed was that if you submit your deck and it's not for us, we'll send you an email, we'll always get back to you, and then we put together a bunch of useful resources in Notion, sort of how to build a pitch deck, why we might have said no, just to help the founder on the next step of their journey. Obviously, if we take a call with you, then we're going to give you more customized feedback. Yeah. Either on a call or email. That's kind of the balance that we struck. We receive around, I think it's like 8,000 pitch decks a year. So to do customized feedback to everyone is just not feasible.
No, I love it. Okay. And I mean, you're kind of touching on there quite how helpful Playfair can be. You've got a Notion document, how to enhance your pitch deck, things that investors need to see. And that helped me remember that you do a post-mortem board meeting with your portfolio companies. Can you tell us what that is and what happens in there? Because I think it's genius.
Yeah. So it's a pre-mortem, because we're trying to do it before death. Yeah, it's this idea. I think we have actually a pretty good set of like initial board meeting content. This is one of them. So we essentially go in and we spend a couple of hours with the founders. Like, what are all the things that might mean this company fails? And typically we'll have picked up a bunch of those for the investment memo writing process. We'll actually have some of those key risks up front. And then the founders will obviously know what keeps them awake at night and what they're worried about. You get it all down, you get it all in a sheet, and then you kind of allocate, you think, what are the top 10? And then how do we monitor them? And so it can be different for different companies, right? There may be some that are more, regulatory focused, if it's, say, health tech, or there may be some that are more competition focused, or there may be some about, hiring challenges, whatever, in that market. But we just want to keep a handle on what are the things that are likely to make that company fail. And I think it's this idea, actually, that we want founders to make novel mistakes. We want them to make mistakes because no one has ever done this before. And again, I'll mention Yasso. When you're trying to build a business in China, novel mistakes come thick and fast, and that's fine. And when you overcome those mistakes, you're building defensibility. But I think in general, we don't want the founders to make the same mistakes that we see lots of other founders make, and that pre-mortem process helps kind of tease it out.
Incredible. Thank you. So I know we're running out of time here, but I wish I could speak to you for many more hours. Is there anything you want founders to know about Playfair that you think they're not as aware of as they should be? When they think of Playfair, what kind of things do you want founders to be aware of?
Yeah, probably two things. So I think one is that we genuinely work as a team. So I think a lot of VCs are sort of individual GPs, run their own little sort of business unit and have support maybe from a couple of other people, and they do their own deals. We do everything together. So ultimately one person will lead the investment, but it means that post-investment, you get all of us. So if I'm investing in a company and I think Henrik's the best person to come in and do a piece of work for them, Henrik will go and chat to them. If we think that, Matt, the CFO, is the best person for time, then Matt will do it. So that's quite unusual in venture, and we're also not proprietary about our investments. So if I source a company, Henrik might lead it, or Chef might source a company and I'll lead it. We are a true team. And I think that's important for founders to know they get value from all of us. It also probably allays that fear as a founder that, well, what if someone leaves? I mean, we don't have many people leave, but also you're going to get to know all of us. So I think that's really important. And I think the second thing is, and this sounds a bit soft and mushy, and maybe it's the lack of sleep and being a new dad or whatever, but I think venture can be done in a nice way. Like, I think I see so much online where it's founders versus VCs. And it's like, VCs are trying to screw you over. I mean, we're just not. We just... we need to, have our business model work, but we want you as founders to go on and be wildly successful. We want you to do whatever you want to do. I've got founders that want to buy boats. I've got founders that want to do whatever, We want you to succeed. And I think that's reflected in things like, we invest in ordinary shares. We don't put stupid preferences in. We don't do ratchets. We don't do that nonsense. We're not financial engineers. We're not even kind of capital allocators. We're more company builders. We like building companies, and I think everyone can be successful. And that's particularly important on the downside. When a company is not going well, I've seen VCs be absolute dicks in boards. Just like really turning on the founders. This just doesn't make sense. Sometimes it doesn't work out. So we've helped founders often navigate, difficult acqui-hire processes, things like this. Yeah, I just think that's really important to know, and it's quite hard to get across in a kind of a website.
Fantastic. Look, wow, this has been an incredible episode. Thank you so much for your time, Chris. We really, really appreciate it. And best of luck with the future of Playfair.
Thank you so much. Been really fun.